Hey there, this is Matt Copenheffer with The Motley Fool, and I'm here with fellow fool and columnist Morgan Housel. We're gonna cover a bunch of different areas here, starting off with Warren Buffett and Berkshire Hathaway. Buffett, of course, is bullish on his own company, Berkshire. He had been bullish in terms of buying back shares. He announced the potential to buy back shares at 1.1 times book value. More recently, he got even more bullish. The board approved a higher buyback price and bought back 9,200 Class A shares at $131,000 each. Quick math gets us to $1.2 billion. What's the story here, Morgan?
So I think there are two things investors should keep in mind. One, Warren is obviously the best investor probably in modern history.
Besides you.
Besides myself, possibly yourself. So what is better for investors than Warren Buffett, the best investor of all time, being bullish on his own company? That's a huge vote of confidence for Berkshire shares.
I mean, what is it? If he's buying back Berkshire, does that mean that he's not seeing stuff elsewhere?
So I think there are a lot of people that say that. I don't think there's much evidence for that. In the past couple years, Berkshire has put tens of billions of dollars to work. Just last year, they made a big investment in Bank of America. They bought 10 million shares of Wells Fargo last year. Obviously, in 2008, he was spending tens of billions of dollars. So if you look at the last couple of years, there's not a lot of evidence that Berkshire is having trouble putting money to work.
So Berkshire's just that cheap, or that valuable at 1.2 times book, which is the new price. So it's that valuable at that price that everything else pales in comparison?
I think that's right. And when you say that price, I think it's important to know that most CEOs are very poor at buying back their own stock. Sure. They buy it back at really high prices. They sell it at low prices. But what makes the Berkshire buyback distinct is that Buffett is putting a valuation ceiling on what he's willing to buy back. So that's really what sets it apart, and it's definitely a big vote of confidence for Berkshire stock. And
the nice thing for investors is that ceiling that Buffett's setting is also ends up being like a floor for shares.
Right, exactly.
All right, well it sounds like good news. Hopefully it is good news, depending on what kind of return Buffett's expecting from those. Moving on. We're hearing so much about LIBOR. UBS is the latest to go down and go down hard in the LIBOR scandal. UBS actually admitted to being guilty. They were fined $1.5 billion for attempting to manipulate LIBOR. Regulators describe this as epic in scale. And two traders are going to face criminal charges over this. Morgan, what should investors be thinking about in terms of LIBOR and what this means for the banking industry?
So I have two things to think about. One, I think there's always been this impression on Wall Street that these people are masters of the universe, they're brilliant traders. I think that's true to some extent, and certainly for some investors. I think it's becoming more and more apparent, though, that many of the outsized gains that Wall Street made during the boom years were based off of dubious behavior. So I think there's one really interesting thing to think about here. Since regulators started prosecuting insider trading at hedge funds, the aggregate performance of hedge funds has declined significantly. Whether that is cause or effect, I think is really hard to say. I think it's kind of pushing it to say that is cause or effect, but it gives you something to think about. So I think as prosecutors and regulators start cracking down on banks more and more often.
So I mean, as we think about the big banks, and especially the ones like Bank of America with Merrill Lynch, Citigroup with its investment banking unit, J.P. Morgan, if they're not doing these questionable activities, is there the potential that the returns that they saw from those divisions aren't going to be as good as they were before?
I think that's certainly the case. I think if investors are using profits from 2005, 2006, 2007 as a proxy of what these banks are capable of earning, I think that's probably a sketchy way of looking at it. It's really possible that over the next couple months, couple years, we're going to start seeing how much of the profits from the bubbles from the bubble years of 06, 07 were generated by these dubious activities.
Is there any way for us to, besides the fact that we're going to be looking at it and saying, oh, profits are down, is there any other way for us to look at it and say, oh, okay, well, that probably was driving profits? I look at what's going on with LIBOR, for instance. And, first of all, you think about the LIBOR setting process, and it involves each one of the different LIBORs, yen LIBOR, US LIBOR. Yep. They involved a whole bunch of banks. They're kicking out the outliers of the submissions. So, the potential for one bank, you said masters of the universe. This makes me think that these guys think they are masters of the universe, that their few basis point LIBOR fixing, as they like to call it, was actually impacting the overall rates.
Well, I think what's difficult about this situation too is that it's nearly impossible, if not totally impossible, to actually go back and see how much these different UBS traders were having on the actual.
It's not stopping people from trying. I mean, we're hearing about billions of dollars here, billions of dollars there. Everybody apparently lost in the LIBOR mess. You're not hearing anybody stepping forward and saying, "Hey, I got a lot of extra money because these guys were fixing LIBOR."
Right. You had companies like Fannie Mae and Freddie Mac that lost billions of dollars when the manipulation was happening, and now you have companies like UBS that are paying billion-dollar fines in the aftermath. So it's pretty much a net loss for everyone.
But I mean, it's not crazy to say that say homeowners who were buying homes at the time, people who were buying houses while this was happening, they got better deals.
To the extent that the LIBOR manipulation was to keep rates down.
Well, which was a big part of it.
At some point, at least for part of the trades at UBS, it was to keep LIBOR higher than it should have been. Actually.
And that's where it would have impacted Fannie and Freddie to losses.
Right.
So then on the other side of it, Fannie and Freddie would have gained to the extent that they were pushing LIBOR up.
It's a huge web, and it's really hard to tell who's winning and who's losing. It's bad behavior nonetheless.
Yeah. Well, let's move on to some happier news. We've got a wedding to talk about here. The New York Stock Exchange has agreed to be taken over by Intercontinental ICE. It's an $8.2 billion deal. The deal would give NYSE shareholders $33.12 in cash per share, or they can opt to take a combination of cash and shares, or they can take just straight shares. Morgan, I think the first interesting thing I'd point out about this is that ICE and NASDAQ put together an $11.3 billion potential deal for NYSE just last year. So this has got to sting a little bit for NYSE shareholders.
Right, so I actually have a story. I was actually at the New York Stock Exchange about a month ago, and I walked past a tour guide who was talking to a bunch of tourists. One of the tourists asked if they could go inside to the New York Stock Exchange. The tour guide said, "You can't right now, but you might be able to in a couple years, and I'll tell you why you might be able to come back in a couple years, is because this place," pointing to the New York Stock Exchange, "might be basically a museum in a couple years, because so little trading is actually taking place on the floor of the New York Stock Exchange. It's all going out to these offices on the sides of Wall Street that are doing it through computers and whatnot. So that I think is a good example of just how competitive the industry has become. Mm-hmm. It's really going out to all these side exchanges, and when you have that much competition, really the only way to survive is to start merging with each other. So
well,
I think that's what we're seeing.
You know, you look at this the Knight Capital Getco deal, where it's basically that's a consolidation play. That's a bigger player in the electronic trading market. Yeah. So with the spreads compressing and compressing, electronic trading taking over, is the only hope for people to get bigger and control a bigger part of the market, do more volume?
I think that's essentially what it is. You have in high frequency trading right now, you have profits that have effectively been driven down to zero. There was an article in the New York Times a couple months ago talking about the industry-wide profits of high frequency trading. It's gone from 12 billion to 8 billion to 6 billion. It's very, very minimal right now.
But wait, I thought high-frequency traders were stealing money from everybody.
Well, they're stealing less and less and less.
Stealing less and less.
Actually, the total number of trades that was that was driven by high-frequency trading was about 60% in 2009, sure. 55% in 2010. It's less than 50% now. So it's declining significantly, and that's because the profits that can be generated from it have declined so much.
So what's the other side of that? If the high-frequency trading is declining as a total percentage, what's on the other side? Do you know?
Well, the overall amount of trading has declined as well, and it's hard to tell exactly where the overall decline is coming from. I think it's very likely that it's from high-frequency trading.
Well, we'll be looking for NYSE's registry, and maybe we'll send a gift to congratulate on the nuptials.
Don't hold your breath.
Oh yeah, that's right. There's a potential of regulatory review there. Moving on to everybody's favorite subject right now, we've got the fiscal cliff on the way. I don't think this needs an introduction. We're all hoping that we don't fall off the edge here. Morgan, when it comes to the banking industry, what should investors in banks like Bank of America, Wells Fargo, Citigroup be thinking about when it comes to the fiscal cliff?
So I think the salient issue is that the fiscal cliff has to do with U.S. debt, U.S. deficits to a larger extent, the U.S. national debt. Banks own a lot of that debt. They own a lot of treasuries. If interest rates were to rise considerably, banks would likely lose a lot of money on those treasury holdings. So when you deal with an issue like the fiscal cliff, where you're sort of putting the nation's debt in jeopardy by kicking the can down the road again and again, the common thing to think is that that's going to push interest rates higher, which would make the value of national debt fall, right? If you look back at what happened last year with the debt ceiling deal last summer, it was actually the other way around. When we came up to the debt ceiling deal, and then U.S. debt was downgraded by S&P last summer, the interest rates on U.S. Treasuries actually fell considerably.
We're the only game in town.
And actually, the day after U.S. debt was downgraded, when it lost its AAA rating, was the second best day for Treasuries in history.
Now, is that a comment on Treasuries, or is that a comment on people just not caring what S&P has to say?
I think it's certainly the latter, but it also is a indication that, like you said, that Treasuries really are the only game in town for investors that are looking for safety. They're not going to go to Europe. They're not going to go to Japan. They're going to come to the United States, the dollar, and U.S. Treasuries.
Well, then it's the Treasury rates and sort of the bottom line interest rates, which are then going to feed through the rest of the economy and potentially wreak havoc on mortgage rates and stuff like that, which are what banks are relying on in terms of collecting on their loans, right?
Right.
So what you're telling me is that Congress has to do something.
Well, they're going to have to do something eventually. And it seems very clear that
you should tell them that, because I don't know.
Guys, I'm looking at you down here. You need to do something.
I feel like they don't know that.
And I think it's obvious that we're going to have a fiscal cliff sometime. Whether it's going to happen in the next week, whether it happens January 1st, January 10th, it's going to happen eventually. And I think everyone knows that. And for investors, I don't think it really should matter when it happens.
So you're saying there's a cliff, there is an actual cliff that's going to take place?
Well,
or there's going to be a solution that's going to come?
I certainly think it's a misnomer to call the fiscal cliff on January 1st. If we wake up January 2nd and there's
it's a slope. It's a slope.
Well, it's not even a slope. If we wake up January 2nd and there's no deal, that's really not a problem at all. If we go a full year without solving the problem, then it's a cliff. That's when you have $600 billion of tax hikes and spending.
$600 billion between friends.
That's nothing. But they could potentially have a deal that was struck, say, January 10th or January 2 weeks later, and make it retroactive to make the changes in the tax code retroactive
like
to January 1st.
Sounds like some serious fiscal sleight of hand right there.
This is how we do things in this town.
It's beautiful. It's beautiful. Well, let's move on here. We've got a former banking bear who is now apparently a banking bull. Meredith Whitney. I love what the Wall Street Journal highlighted. She said that Bank of America has gotten the junk out of its trunk. And she said, "I have not seen an opportunity like this in 4 or 5 years." So that's a pretty significant bullish call from somebody who was seen as on the leading edge of the banking downturn. Do we care?
Well, I think to a large extent, no. I think one thing to think about when she says that this is the largest opportunity she's seen in years, after Bank of America has doubled in price over the last year, seems like sort of a late call. Meredith Whitney had one very good call in 2007 when she made the call about Citigroup's dividend cut. She was pretty much right on the money with banks for the following year. She's had some pretty bad calls ever since. She made the call in late 2010 about municipal bonds. That did not come true, and she was even hesitant to really admit that she was wrong about that. So she makes good points. I think there's a good reason to be bullish on the banking industry going forward. I'm not sure how much weight investors should give any one analyst's opinion, though.
So you're saying that maybe what I should think about doing is making some loud, bold calls and maybe play the spaghetti on the wall theory and hope that one of them sticks.
That's how you get ahead in this industry.
How do you agree? I mean, stepping back from Meredith Whitney and who she is and where she's been, her calls, hits and misses, do you think she's got a point?
Well, I think there are two things to think about with bank stocks. One, they are cheap, less cheap than they were a few months ago. There's been a big rally the last couple of weeks.
But Bank of America, I mean, you talked about it doubling over the past year. It's still at about, last time I looked, about half its book value, right?
Right, so it's still very cheap, which bodes well for the stocks going forward. The other thing you see is the economy at large getting much healthier. Something that could change at any moment. Our record in forecasting recessions and downturns is very poor. But in a broad sense, you see housing getting better. You have this big boom in oil production that's going on. So I think there's a case to make that the economy is getting significantly stronger, and you have cheap bank stocks, and that could be a good combination for investors.
So for the record, Meredith Whitney had specifically pointed out Bank of America. Of course, she also mentioned Citigroup and Discover Financial as well. Although she said, broadly, there's a lot of opportunity in the sector. Morgan just mentioned housing recovery, and it does appear that we have a little bit of a housing rebound on our hands. Pulte Homes, they recently came out and they were talking about how home buyers still want and need larger homes. And just today we saw sales of previously owned homes are at a 3-year high. Property values are up 10% over the past 12 months. Perhaps we should be putting on our rally caps here. This seems like a pretty good comeback.
So 2 things I think is really important in the housing industry. One is that there are 2 ways that housing can rebound when we talk about that. One is a rebound in home prices. One is a rebound in home construction. Those are very different things.
Sounds like we got both.
We have both right now, but I think going forward, if you look back historically, there's really no evidence that home prices nationwide should increase more than the overall rate of inflation. Yale economist Robert Shiller has taken it back to the 1890s. Looking at home prices, they were essentially flat in real terms after adjusted for inflation, essentially flat from 1890 to about 2000, and then you had a huge surge with the housing bubble. But over time, home prices should not increase much more than inflation, and that's probably what's going to happen going forward over the next couple of decades. There is a very strong argument, I think, to make that we could see a big rebound in housing construction for the sole reason that current housing construction is significantly below the rate of overall household formation.
Well, if I'm thinking about owning a bank, we can think about the quote unquote regular classic banks, BB&T, U.S. Bancorp, or the core banking operations of somebody like a Bank of America. Both of these bode really well. I mean, obviously the rebound in housing construction you're talking about, more home sales, more mortgages, and the banks basically have the option to hold those mortgages or just collect the fees and then pass them on. But the property values, I mean, even if that doesn't continue, having that right now, I mean, that should help bolster balance sheets.
It certainly does. And one stat I would share is that just in the fairly minor home pricing, the price gains we've seen in the last year, there are actually 1.3 million fewer underwater mortgages today than there were in January. Well, just from that price stabilization.
That's a big deal.
That is a big benefit for banks.
Sure.
Because when a homeowner is underwater, for obvious reasons, they're much more likely to default on their mortgage than they are if you have
Can't imagine why.
right, exactly. So no, that certainly does bode well for banks.
Great, great. So moving on, we've got some recent news, a lot of recent news on AIG. AIG's been all over the place. I think one of the most significant developments we've seen at AIG is the U.S. Treasury sold off its last holdings of AIG, so it's once again a fully private company. I think this is just so significant. At the time when AIG was bailed out, everybody hated AIG, first of all, for good reason. They did some really stupid things, but everybody thought that this was going to be a terrible idea by the government. They were going to take a bath on this, and in fact, they ended up turning a profit.
Right, so I think if you go back to 2008, look at the commentary, the analysts' comments at the time, virtually everyone said that not only will AIG not pay back their full investment, it was a popular view at the time that they would not get any money back from the government. Maybe they'll get some. Virtually no one, I don't think anyone at the time would have thought that the Treasury would be turning a profit of billions of dollars afterwards. So
I think it's something like $23 billion.
Right, so I think that validates the bailout to the extent that they got the money back. Obviously, you could go back and say the bailouts were created moral hazard. They never should have been here in the first place. They should have wiped out common shareholders.
Well, but if you look at when people talk about moral hazard, if you look at AIG, if you look at Citigroup, if you look at Bank of America, the folks that were in there when all these problems happened, they're no longer there. So
right.
So AIG, you've got a whole leadership change, and I say this pretty much every time I talk about AIG, but Bob Ben-Maché. He's just done such a great job there.
You took the words out, and I was just about to say, I think if anyone deserves credit for the profit that the Treasury has generated, it's Robert Ben-Maché.
He's a baller. I mean, I don't know any better way to put it. He's been brash. He's been outspoken. He's done what he thought needed to be done to make things happen there. I don't want to go too far out on a limb here, because when you've got the government with money backing you, that says something to the market. That says something to your counterparty. So that helps. And I also don't want this to be oh, the government's a great investor because they turned a profit investing in AIG. Right. Same deal. When the government invests in you, you've kind of got this, you know, Uncle Sam's going to chip in, so people are willing to lend to you and stuff like that. But at the same time, even despite that, nobody thought that this was going to happen.
Almost no one. So it's a huge development that we're here. It's a win for taxpayers that we got our money back. Yeah. It's a win for AIG that they get the government off their back. They can continue as a slimmer company going forward.
And I personally think that it's going to be a continued win for AIG shareholders. The stock still looks cheap to me, and given the changes that have happened, the changes that continue to happen, I think that'll continue going forward. My only concern is, again, back to Ben Moshe. He's not going to be there for a whole lot longer.
He's not going to stick around. He's really led the company for the last couple of years, so it'll be interesting to see what happens going forward.
So hopefully he'll play a strong role in picking a successor, and given that we like so much what he's done so far, hopefully he'll continue that with the successor. Moving on to our last one here, we're gonna talk about the platinum option. No, I'm not talking about rocks, and I'm not talking about platinum rings. I'm actually talking about platinum coins here. Back in early December, the Washington Post wrote, thanks to an odd loophole in current law, the U.S. Treasury is technically allowed to mint as many coins made of platinum as it wants and can assign them any value it pleases. Right. So the idea was basically we mint 2 platinum coins, each worth $1 trillion, right, and all of our problems are solved, all of our dreams come true.
So this idea first came to light last summer with the debt ceiling. Mm-hmm. One option was if Congress could not vote to raise the debt ceiling, that the Treasury, which runs the Bureau of Engraving and Printing, could mint, I should say, $1 trillion coin to use to pay the nation's bills. I think what it's a good sign of is just how ridiculous and absurd we've gotten to these points. These crises that we have, the debt ceiling, the fiscal cliff, are manufactured crises that are not issues that are pushed upon us. They're issues that are created in Congress by themselves. So the fact that we're dealing with these absurdities of talking about minting $1 trillion coins, there's nothing you can do but shake your head.
Let's just think, I mean, just thinking for a second, what if we actually did this? Well, I mean, what's the outcome? Does everybody around the world suddenly lose faith? Because, I mean, you're basically creating $2 trillion out of thin air, right, and pretending to pay things with them. Right. Does everybody immediately lose faith in American debt?
Well, I think, no, I don't think they would lose faith in American debt. For one, I think
Is it still an only game in town kind of thing?
Well, sure, it would be, but I think the $1 trillion coin would not work just in the sense that you would still have to split it up into billions and billions of different sections to pay different creditors around the world.
You can't just send somebody $1 trillion coin?
You could try, and I'm sure they would appreciate it.
Can we hop on a flight to China and just present them with $1 trillion coin? Thank you for lending us money. Here's your repayment.
You and I should try it sometime.
I just want to get my hands on one of those coins. So what you're telling me is it's not as easy as minting 2 platinum $1 trillion coins.
It's a good idea. I don't think it works in practice.
That's very sad. All right, this is Matt Copenheffer here, again, with Morgan Housel. We're at The Motley Fool, and you can always read more on Fool.com.